Chief Market Strategist and Portfolio Manager.
What is it? MOT.
At Motor Capital Management.
So you just broke the record for longest title, but it's a good one.
Strazza, I'm excited about today's episode. We have one of our friends from our family at the CMT on the show, David Lundgren. David, you know him better than I do. I know him because I, interact with him at the CMT events. He always usually gives a talk and always insightful, and one of the smart guys, one of the gracious guys over there. We love our CMT guys.
I don't think when we first started doing the show, we had Brian Shannon, and we've been trying to get David on for a couple months now. I think
David, we wanted him like week 2. We tried like when we first started.
David was supposed to be the second episode. We always let Brian be the first at everything because he's special. But seriously, David is one of the master technicians currently practicing. I don't know if I've learned more about markets and actually how to trade those markets. It's one thing to know or to learn how to analyze a market. It's another thing to talk to somebody who really is knowledgeable and understands how to navigate and trade through those markets based on that analysis. That's a one step further than what a lot of great market people are doing out here. So I'm excited about this conversation. We finally got him on.
Yeah, he's a trend follower, right? Isn't he a trend following trader? I love that. See, I have a special place in my heart for trend followers. This is great. So yeah, let's bring him on. Hey, Izzy, bring David onto the screen. Let's have him up. David, how are you? Thanks for joining us today on Off the Charts.
Guys, thanks so much for having me. I apologize I couldn't make it on that first opportunity, but I'm super excited to be here. You guys, I can't commend you enough for coming up with a program of this format, because what you guys talk about on this podcast is so overlooked. But I'll tell you, it's probably 90% of trading is what you guys talk about in this podcast.
We have people on our shows, on this podcast, on our different channels every day who are giving us, great market insights, providing us great research, right? Talking about all those things, but we never talk about everything else that has to be in place for those moments and for that great research to happen, right? You have to be doing everything else right in your life, really, to do great research. And that's what this show is about. So we're excited to get to know you better and in a different light, and talk less about markets and less about charts for a change. So we're really.
Well, I can't promise I won't go down that path, because it is kind of in my veins. But
if it happens, it happens. We won't cut you off. We just allow the conversation to flow. But we're not going to start there for a change.
Yeah, David, you kind of hit it on the head, right? Like, we could talk strategies if we want, and we could talk about setups that we like in the market, and that's great. And if everyone was armed with great trade ideas, that's not the end of the game, right? It's the real work, actually, for many traders, myself included. The real work begins once you put the trade on. Then it becomes an emotional, mental wrestling match that you've got to fight all of your demons. You got to fight all of your urges to take profits or double down on a loser, all those things that you shouldn't do. Those are battles you got to fight. And that's where the real rubber meets the road. Not, having the best setup in the world or having the best strategy in the world is worthless if you can't, manage yourself, right?
Yeah. And I completely agree with that. And the reality is, though, that the mental management is also very much pre-trade, because if you don't have a game plan in place beforehand, you're going to do things you shouldn't be doing anyway. So even if you have the best mindset to follow through on a trade, there's a good chance you shouldn't even be in that trade if it's off your game plan to begin with. So it's about patience and discipline. And, the phrase you use was setup. And what I try to talk about is context, setup, and trigger. And if you every conversation you have with yourself about a trade has to flow in that order. And if you can't get through each of those things and then get out the other end with a trade, then you shouldn't be doing the trade. And that's all pre-trade. That's before you even put the trade on.
Right. Now, I mentioned in the preamble there that you're a trend following trader. And one thing I love to talk about trend following traders about is that probably the hardest thing you do, David, and you could correct me if I'm wrong, but I would bet that the hardest thing that you do is manage a winning position, a trade that is going your way, it's doing everything you want it to do, but every bone in your body wants to take that profit, but you know that you need those occasional, and there are occasional, they're more occasional than we like them to be. Well, we need those occasional monster wins to really make our quarter, make our year. And if you're micromanaging those big winners, you really make it hard on yourself to get those big wins. I mean, can you talk about that a little bit?
Yeah, that's so incredibly important. And there's actually so much that could be unpacked from that statement and from that question. And we could talk about just that alone for the next hour. But I just had a trade. Like, again, you mentioned that I'm a trend follower, and we should probably talk a little bit about, so trend following versus what? What else is there other than trend following?
Yeah.
And so it's trend following, and then the other is swing trading. And swing trading is, I'm going to buy this stock at 20 with an 18 stop and a target of 26. And I don't care if it goes to 100 after that. That's swing trading. And that's perfectly fine. That's a great way to make money, but it's very short-term type of trading, et cetera. Whereas trend following is more about identifying if you're going to be as holistic and considerate of all the data points that matter to long-term trend following, it's going to be the proper technical setup, which includes price trend, relative performance, momentum, and then if you want to really get into it, volatility. But then also overlaid with fundamentals, like the stocks with the best fundamentals, because ultimately, if you want a stock to go up 300% or 500%, that's not going to happen in a vacuum. So if you want to build a portfolio of stocks that you're going to hold for however long you're told to hold them by the market, this is all about putting tailwinds at your back. And if you can put a portfolio together of 30 stocks or 50 stocks or whatever it is, 25 stocks that all have the proper setups, including the technicals and fundamentals, then you've done your job. Now you have to your point, Sean, you have to now just let the seeds that you've planted grow. And it's hard to do. I just had a stock that this is sort of emblematic of the environment we're in right now, but I just had a stock that was up 100%, and I trimmed it just because of volatility, which is one of the inputs I mentioned earlier, and then it went all the way back down to break even. Yep. And now it's making its way back again. But you have to do that if you're going to successfully trend follow. Long-term trend follow.
Is something like that as simple as just using some high-level fundamental filters, sales growth, some sort of floor for margins, margin growth, EPS, right? And then giving yourself a universe, it's going to be a couple hundred stocks at least, and then going to the technicals, right? Basically making sure that the pond that you're fishing in is a quality pond from a fundamental perspective, and then it's all technicals from there.
Yeah, to be honest, I think if you build the best of the best in technicals and you build the best of the best in fundamentals, I think if you sort on one and then go to the other first, or sort on one and then go to the other first, I don't think it's going to matter. I think you're going to end up with the same final list. But the idea is to make sure that if you want to be systematic about it, which is how I am, it's about identifying the combination of those two with the best combination, and then just starting at the top of the list and buying until you run out of money, essentially. And so that usually ends up with 40 or so, 50 stocks. And then just, as I said, plant the seeds and let them grow and pull the weeds as you go.
David, let's go back to that example you just listed a minute ago about how you had a stock, it was up 100%, and you trimmed a little, thankfully, but it came all the way back to break even. How do you keep your emotions in check and not just get so mad and just revenge trade after something like that? How do you keep it cool?
So this is going to sound crazy when I say this, but it's just I don't know of another way to do this other than to simply expect it. Right?
Expect to lose.
Expect to lose. Yeah. The reason is because if you look at the numbers, like I've done a back test study back to the 1950s, trying to develop a model that will identify 10 baggers, or more like 5 baggers, but obviously some of those become 10 baggers. But the point is capture long-term trends. And the number of times that a stock that went on to become a 5 bagger or a 10 bagger or more, the number of times those drop 30, 40, 50% is alarmingly frequent. And to me, I think the issue is, and I actually spoke about this at the recent CMT symposium, where when we look at a chart, like look at the chart of Microsoft, anybody with a pulse will look at that and say, yes, that's what I want. Give me that. And then they then try to capture it. So because they see that long-term 15-year trend of just trouncing the market and just, being a 10 bag or whatever. And they say, yes, that's what I want. But then they go to do it and they try to do it using swing trading. So you can't capture Microsoft over a 15-year period with a William O'Neill 8% drawdown rule. You'll never do it. And what's going to end up happening is in the great words of the master Oogway from Kung Fu Panda, he said, "One often meets his destiny on the path he travels to avoid it." And so you're trying to capture this long-term trend without incurring losses. And all you do along the way, because you're trying to avoid losses, is incur losses.
Right.
But the reality is, if you want to capture something that's going to trend for a long period of time, you cannot use the daily chart. You cannot use the weekly chart. You have to step it out to monthly and quarterly charts.
Yeah.
And when you do that, it's all the same analysis. It's higher highs and higher lows, but all those lows that you see on the daily chart that freak you out and get you to drop out of the trade, you can't even see them on the monthly chart or the quarterly chart. They don't even register. It's kind of like using point and figure.
So you're not getting out and getting back in those situations. You're just able to withstand the drawdown, and you know that that's a part of doing business.
Yeah.
Yeah. It's, I mean, we get hit over the head, I feel like, in financial media about people saying, oh, $10,000 invested in Amazon in 1999 would be worth, $70 billion or some crazy number, right? But what they don't tell you, and you're talking about this, there were at least 5 or 6 or 7 times where that stock had a 75% or worse drawdown from the highs. And it's so hard if you don't have a long-term time frame. It's so hard to sit and hold during that pullback, because as you know, David, doing what you do, you have had probably more times than you even want to think about. You've probably had more times where you've had a big profit and that thing just came all the way back because you're following your process, and that's what you have to do. But because of that mindset that you have, which is so hard, you have caught those 10 baggers occasionally and those 20 baggers. And you don't have to catch a lot of those to make your year, right? If you get one of those a year, that's a great year.
Yeah, it won't be a year, but it's you're trying to capture these trends over very long periods of time, and you have to be willing to sit through it. I use the 100% example because it's kind of fresh and raw and it hurts, but it was relatively recent. But that's not the common outcome. And the truth is, you're usually out even on a monthly chart well before it fully retraces 100%. But it's just that's why I characterize that specific trade as being very emblematic of what's happened in the past 3 years, because it's been really hard, with the exception of a few stocks. We can, in hindsight, identify them easily, but in real time, it's been difficult to identify these stocks that really trend the way that stocks typically trend in a robust bull market. We haven't had a robust bull market, and I think JC would probably argue with me on this because I think he thinks differently about it. But I've been doing this for 35 years, and I know, and we all know what a robust bull market looks like. And I can show you evidence that says it hasn't been. And that's why trend following swing trading has been working great. And swing trading will, in these environments, will definitely work great. But swing trading gets a lot harder when you get into a really robust bull market, because you get out at 20 and it goes to 50. But this environment we're in, you get out at 20, maybe it goes to 23, 24, and then it's at 13. And that's the environment we've been in. So it's working great. And I don't want to disparage trend swing trading, because it's great. If I wasn't doing this, I'd be doing that. It's just this trend following fits me better. So
Is it fair to just say that trends are more reliable over longer time frames, so that's why you do that?
I would say I wouldn't say so. No, I think because trends are trends, and time frame adjusted, you have just as many trends on the daily charts and hourly charts as you do on quarterly charts. Like when I first began as a technician in Boston, I was giving trading recommendations in the old Telerate, which was a precursor to Bloomberg. And I was focused on minute charts, tick charts, 5-minute charts. In a bull market, to me, like a secular bull market, was if I was in a trade for a day. Like that was a massive, like I never held a trade overnight. If we did, we handed it off to the analysts overseas.
And how did you transition from trading that time frame to basically what I'm hearing now is your time frame is as long as the cycle lasts, right?
Yeah.
So how did you go from trading daily trends to now cycle long trends?
Yeah, it happened with my so when I cut my teeth trading bond futures and currency futures and euro dollars and maybe occasional commodities, and my focus changed when I went from that to when I went to work at the Fidelity chart room and started focusing on stocks, and then really trying to incorporate my analysis and show fundamentally minded portfolio managers how to incorporate technicals into the process. And for me to walk into one of their offices with even a daily chart or a hourly chart, I'd be thrown out of their office. So I had to really, that's when I got my CFA to kind of get my mind better wrapped around how they think about the world. And
David, let me ask you a personal trading question about your trading. What happened? What are the things that happen that you get mad at yourself for? Like, what are some things some common errors that you make? I know you're not perfect. None of us are perfect. Tell me something that you do repeatedly and you just get mad at yourself all the time.
That's a long list. How should I sort this list? I'm getting better at things, but I still make mistakes. So I would say relying too much on pattern recognition and seeing something that like I can't name the stocks, but I have a couple stocks in my portfolio where I just systematically I'm being quote unquote forced to buy them, and I'm looking at it, I'm just like, God, this is not going to work, and they're up a lot since I bought them, right? And I'm looking at the pattern, and I'm like, that's head and shoulders top, and it's like this looks terrible, but the process that I've developed to guard me against that very conversation forced me to get in, and so it's generally been questioning or doubting the process that I built to protect me against myself. So it's like I'm being a child and fighting with my parents, When
did you make that big shift and realize that you wanted to be a systems-based trader first and foremost?
I've always been a systematic researcher. Like all of my research has always been backtest, model driven, things like that. But in terms of actually translating that systematic research into a portfolio management process, frankly, it wasn't really until I recently left Wellington, because that wasn't how we manage money. We managed money. We were discretionary, systematic research, and that was my role on the team, was to provide that systematic research and idea generation. I eventually took over the portfolios and then the technical research group. But as a member of the team, it was systematic research. But for me personally, I prefer to not just do systematic research, but systematic portfolio management. And so when I left Wellington and started my own firm, I'm now managing a hedge fund and a couple of SMAs, and that's all systematic because that's just the way that I believe it should be done, for me anyway.
And then, so let's just clarify the difference between these two things. You were at an institution on the buy side where your process might have been systematic, but then you were working with a discretionary fund where you would take those ideas that spit out of the system, and then you'd have to convince them to either get in or not get in. Is that right?
Yeah, or like the idea is like the great strength of technical analysis, whether it's systematic or visual and discretionary, is that you can pretty readily eliminate the things you should not be doing. Like if you're a trend follower, don't buy downtrends, right? If you're being honest with yourself. So whether you do it systematically or with discretion, the idea is to cull the list down to the list of the best ideas, and then you can work with that from there. And so you can either work with that systematically, which is just sort of best to worst, and just keep buying until you run out of money, or go through the list and say, this thing is perfectly set up. It's right at support, just about to break out, by this one. And that's how I would function. That's the kind of role I function more at Wellington before I, transition.
David, I find this fascinating. So you arrived at systematic trading basically at day one because you were systematically inclined in other things that you do in your life. I feel like most traders who get into systematic trading, and I certainly was one of these. I was a systematic trader for a long time. I traded commodities years ago, and with a trend following strategy. And I arrived at that because I quickly identified early in my trading career that the biggest deficiency in my trading was my emotions. And to me, systematic trading had such a great appeal to me because I'm like, oh, I could have a rules-based system that takes my emotion out of it, or at least that minimizes the effect of my emotion. That was a huge eye opener for me, and that's what drew me to systematic trading. But I like that you came to it because you were already systematic in nature. I feel like that's kind of rare. I don't know, Steve, would you disagree?
No, not at all. I also think David could probably talk about applying characteristics of trend following to his everyday life. Like, do you feel like you're a trend follower outside of the markets also?
That's a really funny conversation.
Well, look at his shirt. He's a stylish guy. He's following trends.
No, but seriously. So no, I'll give you an idea of what I'm talking about. You're buying real estate. Buy it in a market that's working. That's still market stuff. We're in traffic the other day coming home, trying to drive home to the Keys. There's traffic. I said, we're not going to sit in this. Let's just stop and eat, right? Like, don't go against the grain. Follow the path of least resistance, not just in markets, but in life. I think there are parallels.
Yeah, I think, momentum in trend following in specific is kind of a paradox unto itself, simply because trend following is, as it states, following trend. But it's extremely difficult to do, and most people don't want to do it because it's extremely difficult to do behaviorally. So in a sense, what I do as a trend follower is extremely contrarian, right down to whether it's application or the philosophy of the whole thing, like the idea of buying something that what nobody wants to buy with something going out to new highs. Nobody wants to do that,
right. But
that's trend following. So in a way, what I'm doing is very contrarian.
Huh. I never thought of trend following as a contrarian strategy, but you're right. I mean, you're absolutely right.
Yeah, philosophically, very contrarian.
Now, sorry. Go ahead, Steve.
Yeah, I want to just keep it on the systems thing. I want to go back because this show, we try to keep it for new traders, right? People who are trying to get involved and learn from the people that we have on the show. You're talking about being able, or you have this special ability to stomach large drawdowns. I'm thinking back to our conversation with like Jason Purse, Sean, right?
Yep.
Early on, that's not easy. Now you're sitting back like, yeah, I can stomach a 40% drawdown because I know what happens after, right? You know what comes next. You've been doing this for a long time. But on day one, how do you program yourself to say, this 30% drawdown, or correct me if I'm wrong, I don't know, what your floor is. This 30% drawdown is simply a cost of doing business, and I know it's going to be okay. How do you do that as an early trader who doesn't have much experience?
Man, I wish there was an easy answer to that question, but it's I have an answer, but it's not an easy answer. It's a difficult one to hear.
Yeah.
But the only way you're going to learn it is to do it.
You just got to try it.
There's nothing I can say to you to make you go, oh, if I think about it this way, I won't mind a 30% drawdown. And by the way, I want to be clear that the 30% drawdown is at the stock level, not the portfolio level, right? So, but nonetheless, 30% is a lot. And but once you get going, the idea is that you experience it enough and you recognize that, because you have to experience the upside. So my son Gavin is working with me now. He joined out of college recently, and awesome. He's been in the markets trend following, systematic trend following, long not short, but going long and going into cash for 4 years now, I think. And think about what's been happening over the past 4 years. It's been crazy markets. He actually hasn't experienced a normal bull market. So he has not experienced 100% gain. So all he's experienced is the hard part of trend following. Mm-hmm. And so in many ways, I'm kind of like glad that this has been his window into trend following, because he's really understood what it takes to do this when it's not working.
He's getting
now it's just cherry and it's icing on the cake from here.
Learning all those hard lessons. So did you have like really great mentors or really great teachers like who taught you to kind of keep the faith in those moments when you're drawing down 30%? Like it'll get better. Like how did you know to stay the course early on?
I think I would say like I have an incredible fortune of some of the people that I've worked with over the years, whether it's some of the best fundamental stock pickers I've ever known, I've had the fortune to work with, or working with Frank Texera over at Wellington, who's one of the best technicians, portfolio managers, who's of our generation. Folks like that, I'm just extremely fortunate. But to be honest, at the end of the day, the best teacher that I've ever had is the market itself and my interaction with the market. So I journal when I have a research product. I don't find it as necessary to journal because that's essentially my journal. So I haven't really been journaling since I started the company I have. But when I'm not writing research for others, I'm journaling all the time. And the value of it is to be able to go back. It's hard to write about it right now and really know what to say or figure out, like, especially if you're new to journaling, you really don't know what to say in that moment. But it's almost like today, if I feel compelled to sit down and journal, I kind of know what I want to, like, I know how far to dig through the flesh to get to the bone, because I know what kind of gems are going to I want to reflect back on 6 months from now. Because I really, in the raw, I want to know what I was thinking in that moment. And that's where the lessons come from. And invariably, it's like, had I just, not gotten so anxious about it and build up so much anxiety and just listen to the market. Because what I find is that if you ever feel like really anxious about what's going on in the market, it's because you're not getting from the market what you expect. And those aren't the market's expectations, they're your expectations that you put on yourself. And so usually if it's something like when I go back and read my journals and I can see what in hindsight, what I was feeling and thinking and what the market was clearly in hindsight trying to say, that conflict was because I wasn't listening to the market, or I had an overwhelming sense for some outcome that I couldn't sense in the moment that that's what I want. But when I look back 6 months, I'm like, that's my problem. So now today I'm just like, I'm so agnostic, I can't even stand it. I just have no expectations.
So you took the words right out of my mouth. Managing expectations is a huge part of what
Number one.
Expand on that a little bit. When you go into a trade, typically, what are you thinking?
So I said earlier that I expect to lose. That's kind of like a bumper sticker way to say it, because it's kind of catchy and you won't forget it. But and that's the point. But like I don't just randomly expect to lose, although that literally I do randomly expect to lose. But I don't just like for no reason or just for my own proper mindset. I don't just say, well, I'm going to expect to lose. I expect to lose because that's what the math says. Yep. Right. If you're through a full cycle, you should expect to lose half the time.
At least.
No, exactly. No, that's
what our win rates are like.
I was just about to go there, and I think Sean, this is what you were thinking. So when you see a statistic, like when you see a strat, this is even one of the hangups. You can even have all the statistics of the strategy, and you have those statistics because you want to be a good implementer of the strategy. And so you study the statistics and you understand over a full cycle, I'm going to be wrong half the time. So that's your mindset. I'm going to lose half the time. That's still not good enough, because a cycle is a cycle. Meaning there's a good part and there's a bad part. And in the bad part, you're wrong 70% of the time, 75% of the time. And you're like, well, that's not what it was. That's not what the number said. It said 50% of the time. Well, remember, 50% is an average. And in bear markets, when you're trying to buy, get long or whatever, you're going to be wrong a lot. So you need to keep your losses even lower than usual. But the flip side is in a bull market, that average, you can be so wrong in a bear market, but the average for the cycle comes out to 50%, because in a bull market, you're right like 80, 85, 90% of the time. And now you think you're a genius when it has nothing to do with you. It has to do with the strategy and the process and the fact that it works out to 50% of the time over time.
So maybe this question answers itself, David, but why do you think people, and when I mean say people, I mean traders and investors, why do you think they could be given a strategy that The numbers prove it out that this is a strategy that works, whether it's trend following or dollar cost averaging or I don't know, selling options premium, strategies that have high win rates and long-term success, track records of success. Why do people have such a hard time sticking with those strategies when they don't work, when they're not working during those periods?
It's poor education in really misplaced expectations. That's all it is. Like Warren Buffett says all the time, and Charlie Munger used to say frequently, that if you go into this endeavor not anticipating that you're going to lose half your money at some point, you should not do this at all. So half your money is a lot. So that I obviously endeavor not to do that. But if you look at a back test and you go into it thinking that you can do this, and then actually get into the knife fights that are required to earn that back test, that's where the disconnects are. You don't appreciate how hard it is. It's actually not that easy. It's actually really hard. Should it be any other way? Shouldn't it be really, really hard to do this? Yes, it should be really hard to do this. In fact, when it's easy to do this, that's when I'm like, man, I'm going to start raising my stops, because it's not that easy. We all know this.
Right. One little trick that I've actually just recently started with myself, David, is as I employ a somewhat systematic option strategy in index options. It's not fully automatic or fully systematic. There is some discretion involved, but more or less it's a strategy that I stick to day in and day out. And one of the tricks I'm working with to help me manage my emotions during the drawdowns is I know what my biggest drawdown was in this strategy, and I just double that. And then I look at my equity level. I'm like, all right, well, my equity minus what double my biggest drawdown is from my high, that's really what I have in my account, right? So let's just make up numbers here. Let's say I have $100,000 account, and that was my high watermark, but my biggest drawdown was $10,000, right? Well, for my personal accounting purposes, I'm treating it like I have $80,000 in my account.
Yeah.
Because I feel like that gives me enough wiggle room. That's double my worst drawdown. So worst case scenario, that's what I have. And I don't know if it's a trick. I don't know if it's going to work for me when the shit really hits the fan, but it helps me just kind of, I don't know, weather the storms a little bit when drawdowns are happening. And like, I'm trying to okay, hey, look, I think I could lose a lot more, but I've actually only down this much. It's not a big deal. Just keep doing what you're doing.
It's like a mental stress test for your portfolio.
Yeah. One thing I used to do when I was kind of getting into the groove of longer term trend following was when I look at the portfolio right now, and if I get stopped out of everything, I know exactly how much I'm going to be down, what the drawdown is off the top. Really? And what I used to do is I used to track that as my portfolio value.
That's scary.
Because obviously initially it's scary to take that, which usually an 18 to 20% hit if I were to get stopped out of everything.
Right.
But once you're there, that's your number. And now with if this is your number and the portfolio is going up and down all over the place on top of it, experiencing all kinds of volatility, this doesn't move because your stop doesn't change. So from day to day and week to week, this is a very stable number. And it actually creeps up a little bit as your stops rise.
Yeah.
And that sets your mindset properly, and it really quells the volatility in terms of what goes up and down day to day. And I think it can make it easier.
A similar strategy to both of what we just talked about there. I learned this from Peter Brandt. I know you know Peter Brandt. He's a friend of mine. One thing that he does, I don't do it myself, but I like it in concept. How he manages his equity, or the way he thinks of his equity, is he only counts his equity based on closed trades. So if he's got an open position, he doesn't think of that as his money. It's not until that trade closes. So really, he could be sitting on a couple really big winners, but his equity levels down here, just, all the little small losses he's taken all along are all just kind of chipping away at that equity. And then eventually he'll close a big winner and the number will come up, but he's always thinking about closed equity, cash in his account. That's all he cares about. And I like that. I think that's a good strategy too.
Yeah, that's somewhat similar to what I just said, but it probably has a bit of a better representation of what the portfolio is actually worth. But the idea is to find ways to remove your tendency to follow things day to day. And I'm speaking strictly from trend following. Like if I'm a swing trader, that's like you own a retail store and you're managing inventory. You have to know what's in your inventory at all times. So you're running a business differently when you're swing trading versus trend following. So I would just want to be clear about that.
Well, the interesting thing too about trend following is that you, as a trend follower, experience the most portfolio volatility when you're sitting on big open profits.
Yeah.
It's like a weird juxtaposition, right? Like this is the best time for your portfolio, but you're also suffering some wild gyrations in P&L from day to day.
Well, it's August 28th while we're taping this. This will probably be out in early September. If you look at some of these AI stocks, like the biggest leaders this cycle, they're in 30, 40, 50% drawdowns right now.
Yeah. Yeah.
If you zoom out on those charts, they look incredible.
Yeah.
Charts that we buy as trend followers, not charts that we sell. So it could be hard looking at your account and what your account is telling you, right? And all the red versus looking at the chart as a trend follower and what that's telling you. And there's a huge disconnect there. Right. Does it get easier though, right? You talk about how you've been doing this for a while and you seem very comfortable doing it. Do you get just as nervous today as you would have earlier on in your career in these drawdown environments? Or now are you like, whatever, I'm going golfing. I'm gonna play 9. I'm leaving at 3:30 today. Everything's good. Like, does it ever get easier?
Well, that does, simply because, in the years that I've been trend following, what happens in an afternoon never matters. I mean, if there's a scenario in the market where it's critical for me to be there for that, that 1 hour in the day because of what's happening, the market's already warned me about that scenario months ahead of time, because those things don't just happen out of nowhere. Like the global financial crisis, that didn't happen out of nowhere. The perfect example is the volatility surge we had in the beginning of this month,
August 5th.
And that's a scenario where it's a great example of what I think you need to do to have proper mindset for all things in all contingencies. So you can't expect that something like that's going to happen. You can't forecast. You can't certainly trade ahead of it thinking it's going to happen, because you'll basically erode your capital trying to trade around those things or anticipate them. But what you can do is assess the environment ahead of time, so that if it happens, ahead of time what levels need to hold and what kind of structure is beneath the surface to withstand that kind of sudden volatility. And when it happened, I was of course I didn't know it was going to happen. I was thinking that we were going to have a weak quarter into the elections, but we basically got the weakness I was expecting in 2 days. But the idea was that my mindset already beforehand was that whatever happens, I want to be buying weakness. It happened to happen that it happened in 2 days. And by knowing ahead of time that, well, two things: knowing ahead of time that I already wanted to be buying weakness, that's what I was doing. I was in there buying weakness and selling puts. But I was going to add something else. I was going to ask me another question. I think you think we can ask me a question, and I'll come back to my other point
about how the evidence or the writing was already on the wall, and when the volatility hit, you weren't shocked. I mean, Sean and I have gotten a hard time over the past, it's been like 2 months now, Sean, where we've been sounding, I don't know, more cautious than we have probably for the whole cycle, right? Like the character of the market changed a bit ahead of the volatility event that happened in early August. Yep. What I would love to know is, how can you differentiate between warning signs that speak to a corrective wave versus warning signs that speak to the end of the cycle?
Yeah.
That's something I struggled with just over the past couple of weeks.
I think I'm speaking for myself. So whatever you said before, or whatever your analysis was before, I'm not speaking to that. I'm speaking to myself, because that's all I know. I was, and I'm sure you know this as well, and I'm sure you identified the same thing, that we pretty much hit an internal peak in March. And then since then, we've been getting more and more divergent as the year has gone on. Yep. And so I've also been saying we should be anticipating weakness leading into the elections, but you want to be a buyer because the structure is good. Now, Could I say in hindsight, with that flash crash of volatility we had, that I called that, or that I identified the environment in which that could happen? I could say that, but I'm not going to say that because that's not really what I said. Those kinds of events are not, I don't believe, I'm speaking to myself, I can't forecast them. What I can say, having studied them both from a implied volatility perspective back to 1990, as well as a realized volatility perspective back to the early 1900s, is that those volatility events, those types of volatility events, like if you look at the biggest top 20 volatility events since 1990, most of them have happened in a bull market.
They're counter trend.
It's perplexing. Like, how can you have such incredible, sudden, what would seem to be like game-changing volatility, and then just have the market recover and off to not only recover to new highs, but post some really astounding gains over the next 6 months? How is that even consistent? It's because they happen in bull markets. When they don't happen in bull markets, global financial crisis, 2015, when you have those kinds of environments and then you get a flash crash like that in volatility, that's when they don't immediately come back. So it's all context, which is kind of what I said earlier. It's context, setup, and trigger.
So are you saying to me right now that a textbook characteristic of a bull market, looking back through history, is big time spikes in volatility?
No, I'm saying that a textbook characteristic of bull markets, let's say it this way, a textbook distinctive characteristic between bull markets and bear markets is that these volatility events happen all the time. Wow. They happen in bull markets, they happen in bear markets.
Okay.
When they happen in bull markets, like for example, since 1990, when looking at the top 20, the median number of days from a 52-week high after on the day the spike happens is 8 days. So just 8 days before we were at new highs. And after the volatility spike on that day, when you look at how far down the market is, the market's down about 5% from its highs. It's a bull market phenomenon, right? So because it's a bull market phenomenon, that means that the structure beneath the market is viable, such that it can stabilize quickly and recover to new highs.
Yes. When
they happen in bear markets, this is not weakness you want to buy. This is global financial crisis. There's another volatility spike, but it's a different context. So what I'm saying is that what distinguishes a bull market from a bear market is its ability to recover from these things quickly. Right. So it's not about forecasting them and knowing when they're going to happen with certainty. It's about knowing what environment you're in right now so that if it happens, you know what to do about it.
Right. I wonder if there's a way to quantify it a little bit. Like, would there be a good heuristic? Like, if we have a massive volatility spike that began with the major indexes above their 50-day moving average or above their 200-day moving average, then this is a dip that should be bought. But if it happens below those averages, that's where you should be a little bit more cautious.
I think at a very high level, there's a lot of reasons I don't do it that way. But to answer your question, I think that's at minimum a great place to start.
Yeah, that would be a good jumping off point for a back test for sure.
Yeah.
Is this really any different? Like, we all know that the biggest up days and the biggest, short-term rallies happen in bear markets. Is it any different? It's just the flip side of that, right?
Exactly right.
I want to talk, David, you've taught me, so about 4 years ago, we had a conversation, you probably don't remember it, where I was thinking to myself that I'm better off just not trading in bear markets. I'm bad at shorting. I don't like it. It doesn't really work with my personality. I always fuck it up. And you told me something that was just awesome, and I'll never forget. And I know that now every time I talk to you and we do media together, I make you talk about this. But explain how you view, being on the long side different from being on the short side, because I think a lot of traders think that they could just flip their process on its head and do the reverse and it'll work in bear markets. And I don't know how true that is.
So, obviously definitionally, there is no such thing as long-term trend following on the short side.
Yeah.
Right. So that alone as a stepping off point into this distinction tells you immediately that you can't use like trend following in long-term trend following. There's no such thing as targets. Right. It's trailing stops, volatility, things like that. Whereas in shorting, the better the trade goes, the more you should be thinking about covering it. Now, that means that you could get out at 20 and it goes to 0. But so what? That's just the skew of shorting is just so against you that you have to be. So it's more like long-term trend following is opportunity management. Short-term swing trading on the short side is risk management. Managing your risk on the short side is paramount.
Right.
Whereas managing, like, it's like long-term trend following, it's not that you're not managing your risk, but you have to take on more risk. You have to be willing to let something go down 30, 40% in order to capture that 50%, that 500% move. You can't do that on shorting. There's no reason to do it. Like, you can't expand your stop because you think you're going to go past zero. So the skew is so far against you, you must stick to that expectancy formula like a religion.
Right. The absolute most you can make on a short trade is 100%, which is a great return if you can get it. But Steve and I talk about it all the time.
Hate it.
Bear markets are attractive to traders because if you're on the right side of a downward trend, you can make a lot of money in a hurry, right? But there's a huge timing component to that. And the bear market bounces are so hard, right? If you're holding a short position, those bounces can be so tricky. I know many people, myself included, who've been chopped up many times trying to get short something that's in a downtrend. And yeah, the long-term trend is down, and I'm working with the trend. But man, it's so easy to get stopped out of those trades before you even see a real profit. It's so tricky.
You're differentiating between trend following and swing trading, and how you have to use swing trading when you're shorting, which means targets. So when you do get like a 40% move in your favor, you should take that profit. And I think one of the I'm not sure I'm going to be able to explain this clearly enough in this conversation, but I think one of the risks or problems that people have when they're shorting is that they think that the lower the stock goes, the smaller the position becomes. So it's a smaller risk in their portfolio. And I think that is a big mistake. Now, I've explained this concept a million times, and everybody disagrees with me. But I just think about it. When you buy a stock, and as the stock goes up 20%, and you bought it at 100, it's now let's say it's gone up 20%, so it's 120, and it's let's say it was $100 to begin, so now it's $120. What's the value of your position? Well, it's your cost basis plus your profit, $120, right? When you short a stock at 100 and it goes to 80, what's the value of your position? Everybody will tell you it's $80. It's not. It's your cost position plus your profit. So it's still $100, right? So you actually have a lot more in that position than you think. And it's still the same number of shares. So it can go up against you basically ruin your profit very quickly, because it's still the same number of shares. So the risk is people say, well, it's a much smaller position, so I'm going to add more to my position now to make it a bigger position because it's not affecting my portfolio enough. And then you end up compounding the problem. You're selling into weakness to try to make your position bigger, to make it more meaningful to the portfolio, when you don't really have to do that because it's still the same number of shares. Yeah. And you end up compounding it when in fact because the profit is made on the short side by the stock going down, you ignore the fact that there's a profit in it when you're thinking about how big the position is. Yep. Whereas when you're on the long side, you're looking at your cost basis plus your profit. You should be doing the same thing on the short side, and you realize that, hey, this is still a big position.
Yeah, I love this. And isn't selling puts just a more extreme example of that? Where your position that your broker tells you does not reflect what it really is.
Well, it depends on how you account for it, right? Like if you're doing cash secured puts, right? That means you're
I'm talking about if they're on margin though.
Right. I think people can get themselves in trouble by selling a naked put and only thinking about the margin requirement as that's what the value of the position is. A conservative trader will say, no, the position is worth, 100 shares of stock at the strike price. That's what it should. That's how I should treat it. But you're right, Strazza. People make that mistake all the time, especially new traders.
How could you be comfortable selling puts in early August, David? How did you do that?
Because he had a plan. He said he had a plan going in.
Yeah, no, that is the answer. Like I was, I had to change my underwear after I did it, but which is to say that I'm not saying it was easy, but it's like it's one of the best stock pickers I've ever worked with. His name is John Marishano. Left Fidelity with a few Fidelity guys to start this hedge fund with him, and to this day, he's one of the best investors I've ever worked with. And he used to talk about this thing called his tuning fork. Mm-hmm. And he was just to give you a sense for how good he was. We all know Bill Miller and how Bill Miller beat the S&P. I think it was 15 years in a row. So during that 15-year period, this gentleman overlapped 7 years of that window of that 15-year window. And in those 7 years, he not only beat the market, he beat Bill Miller. That's how good he was, right?
Wow.
So he had this thing called a tuning fork, and he would listen to it. It's basically his own body telling him what to do. And in those moments where it's almost like Strazza, it's kind of like when you ask, like, what do you tell a new trader? It's like, this is what I could tell you, but you have to go through it a number of times to realize that this is what you should do. And it's almost invariably the thing that you least want to do in that moment. But the idea was, it's like the last thing I felt like I wanted to do, but I knew ahead of time that I wanted to do it. And in my calm state, and if you ask me would I do that, I'd say 100% I would do that. And so now when it's happening, it's like, I'm going to have my conversation with my calm self in about 2 days, and I'm going to either say I did it or I didn't do it, right? So so that was why it was quote unquote easy for me to do it. Not easy, but you know what I mean?
Yes.
So just fast forwarding to today, it's like, could have I done things better? Could have I done more? Absolutely. Could have I executed better? Yes. But when I look at what I did in this vol crisis versus other ones throughout my career, it just progressively gets less and less bad. We'll say.
Yeah.
That's pretty good.
You know, the reason why that trade paid, David, is because it was hard, right? The hard trades are the ones that pay. It's never the easy ones, or it's rarely the easy ones. It takes a certain intestinal fortitude to step into the morass when things are telling you this is too risky. But those are the trades that pay.
Can I take 2 seconds just to explain though, why was my mindset what it was?
Please. Yeah.
Right. So one, having ahead of time the knowledge of what, when these volatility spikes happen in a bull market, what you're supposed to do was one. Knowing ahead of time what the structure of the market was before this happened and what levels had to hold, knowing these things before it happened, not expecting that it's going to happen, not that I forecasted it was going to happen, but when it happened, I knew that these things resolved well 6 months out. I knew that the structure of the market was good and getting better. Definitely not robust like we would typically see in a robust bull market, but good and getting better. And then to be clear on what I did, I didn't just go in and let's say I have a 1,000 share position. I didn't go in and sell 10 puts on to bring on another 1,000 shares if it gets put to me. It was just a small increase my position by 10 or maybe 15 or 20%. So maybe 1 or 2 options or maybe 3 options to take on 300 more shares in the position. And that strike price, if it was put to me, is above my stop. So if I can't find something that meets all those criteria, I'm not going to do it. I'm not going to get put to me when I'm trying to actually get out of the stock, right?
Right.
And then also it turned out that there's been other times in the past, but where I couldn't do this because of this final metric, which is the trade has to pay off. Like it has to be an egregiously stupid amount of return in such a short period of time that it's like crazy for me not to take it. So I in terms of, I don't know if there's a fancier way of doing this, but it's just basically I take the premium that I take in and divide it by the strike price and annualize it. And I was getting 200, 250, 300% annualized to write these puts.
That's a good way of thinking about it. I like that. I like that. One thing you haven't said, David, is that I would imagine that one of the things that gave you some confidence to step in and sell puts into a, ripping apart market is that you're paying attention to position size. You're not just throwing 100% of your account in any one trade. Can you talk a little bit about how you think about position size and how you keep your, keep each position manageable in your portfolio?
Yeah, I mean, I think that's a key part. And the position sizing for me is about starting at the same, because again, it's literally the benefit of trend following is it's like watching a horse race. but you can change horses as you see the race go. You can't do that in a real horse race. As soon as the bell goes off, your bets are your bets. But in horse race, in horse racing in stocks, you can make these changes. So what I do is I start with basically an equal, basically a 2% position is the initial size. The only time I don't make it 2% is if the volatility of the stock is so great that it can contribute more to on any given day to the portfolio's volatility than a certain amount. And if it's just so volatile that it's going to go above that threshold, then I'll take it down to like 180 or 170 basis points, so that if it experiences that random volatility, it will still be the same volatility as everything else in the portfolio. But by and large, it roughly comes out to 2%. Then once you're up and going, you really want to stick with positions. I have positions in the portfolio that are now over 3%. And it's just
because they're working.
Yeah, it's just working. And then I have other stocks that are positions that are invariably and this is like a mindset change for me, Steve. I think you were trying to get to it earlier, but yeah. If I have a stock that I bought at 2% and it's now at 170 or 160 above my stop, because it's at 170 or 160, you can imagine the vol on that stock is quite high. People are freaking out because it's experiencing weakness right into support. And it's now a smaller position than what I had originally made it. And I want to bring it back up to the 2%. One of the cardinal rules, which I vehemently disagree with, at least as a blanket statement, is you should never add to a losing position. I just categorically disagree with that. And I shouldn't say categorically. It's not always true that that's the case. And so what I will do is I will, instead of just going and buy the stock and to bring it back up to 2%, I'll go in and sell puts to bring it back up to 2%. And if it never gets put to me, then I just put the premium in my pocket and the stock is back to 2%.
Interesting.
Right? So it's never about selling puts so that I double or triple my position if it gets put to me. I never do that. But it's just constantly what my mindset on that whole thing is that if through the course of a year I can generate 2.5% yield from doing that over the course of the year, why would I not do that? And I'm just taking advantage of the people of the volatility that's created from people freaking out just because the stock's pulling back. And I have a video out on our YouTube channel. It's called "One Investor's Bear Market is Another's Opportunity." And
what's your YouTube channel? Oh, what's the channel?
It's Motor Research, I think.
Motor Research. Yeah.
MOTR.
MOTR. Thanks. Yeah, Momentum and Trend. It's an acronym for that. But the idea is, and it's about. To me, this is like one of the biggest mistakes we make. It's absolutely one of the biggest mistakes I made over and over again in my earlier years was, and I alluded to it earlier, and it's trying to catch big trends by using, while managing risk as if I'm a swing trader. And so that big downdraft we just had in the market is extremely important to a swing trader. I'm not diminishing that at all. Hugely important, but to me, it was opportunity. Right.
There's so much wisdom here. People can apply this to their individual accounts too. You're obviously managing larger sums of money and doing it on an institutional level, but anybody can do these things. The way that you think about markets is truly incredible. Do you feel like you've mastered this?
No, not even close.
And why?
Because it's unmasterable. It's not. That's why I do it. I'll tell you what. If I ever feel like I've mastered it, I'm going to go find something else to do. I'm done.
Oh, I like that.
So is that what keeps you passionate about this? The fact that it's still challenging after all these years?
Yeah.
Right? You're still figuring out new things, new tricks, new sleeves to add.
We're like professional athletes getting paid to do what we love to do, but our career doesn't end in 6 years or 7 years because we're beat to death. We actually get better as we go. And we, if you're getting better as you go, presumably that means that your income is getting, is growing commensurately with that. And the saying is that, the saying that there's nothing new under the sun.
Yep.
We're all familiar with that. That saying comes from the Bible, the Old Testament. Right? That's a pretty old statement.
That's pretty old.
Right? So that means that there's this ongoing, recurring human nature, to life, to society, to investing, to economics, to all these things, and it never changes. And so it's just about being incredibly humble about it.
Yeah.
For me, like whenever I talk about this stuff, I'm not talking to anybody. I'm speaking about myself and just trying to be humble about it and recognize that I will never know. Like the idea of putting the burden on yourself of the expectation that you're going to figure this out is like laugh out loud hilarious. It's ridiculous. So, but if you can go through this endeavor with the mindset that I want to find a way to listen and learn and just get better every day. That's you just to be able to find something in life, to be able to do that. It's just so fortunate.
That's beautiful.
So fortunate.
So, David, when you're not thinking about stocks and trading and managing money and all that stuff, what are you doing for fun? What are some hobbies you like to do outside of the market?
Well, my three favorite things to do are probably at the top of the list is sailing, and the overlap between sailing and trend following should be discussed.
Let's discuss this. I want to hear this. I want to hear your take.
Sailing is about just being in the moment and just going where the wind takes you, and recognizing where the wind's coming from and when the wind changes. And if you want to maximize the speed of the boat it's like in trend following, there is no destination, right? It's just like there's no target. You just go until the wind changes. And that, I think that's why I love trend following, and I know for sure that's why I love sailing. And the other two things I do in my life are it's all about risk and managing risk and not doing stupid things, because you can either lose or get really hurt quite badly. So I like to go out west and ski and cat skiing and do some pretty deep powder skiing. And I have a propensity, despite my repeated record of smashing into trees, I don't know what it is, but I love to ski as close as possible to trees, to the point where I'll just get like a cut across my face, or I'll ski. I almost got impaled on my last trip out west. It's like risk taking that's just like completely uncharacteristic of me, but I can't.
Is it risk taking though, or do you get like some kind of comfort by being close to the trees? Like, hey, they're gonna catch you if you fall, that kind of thing.
Or impale you, yeah.
But David, this is a departure from everything else you're saying. You sound very conservative, like cool-minded, like even-keeled. And now you sound like this crazy, I need to be stimulated and ski into a tree person.
Well, there has to be I think there has to be an outlet, right? There has to be.
Yeah, that's where he gets his rocks off, Strazza.
Life is yin and yang, and you need both, right? And there's no way to know what dangerous is until you know what's not dangerous, right? Because everything else, if all you know is danger, then there's nothing to call dangerous, because there's nothing to compare it to. And so to me, it's like the other one that I love to do, despite my results, is golf. But it's definitely figuring out, like, okay, I just had a bad drive. How do I turn it into a par from here? And then you got to figure out what's the least risky but most productive thing I can do from here without preventing myself from getting what's eventually a bogey. But it's like if it's a par four and I kind of drove it to a bad spot, how do I get in four from here? So 5 in total. And it's all about knowing where the bunkers are and knowing where the water is and what your strengths and weaknesses are, and just trying not to be a hero.
I think there's a great corollary between golf and markets, which is just that losing your mind is not just very possible. It's the worst thing that could happen. It's all mental, right? Like the biggest downfall when you're out on the course or you're in the market is you just lose your mind. You get so frustrated. Sean was talking about revenge trading. I revenge trade on the golf course all the time. I'm so glad I'm at my desk. I'm just, you shank a drive and I'm like, I'm just taking out my fairway wood, then I'm going for it. It's like,
Yeah, exactly.
Well, we don't want David to get revenge on us for keeping him for too long. I think we've already kept him for well more than an hour. So we appreciate all this. Yeah, no, this is really great, David. Yeah, so much wisdom in everything you said. I mean, just that sailing thing, we could talk about that for the next hour. I have a quick question for you, though. One of the times that Steve and I and JC get to see you most frequently is at CMT events. When's the next big CMT event? It's been a while that I've been to one.
No.
Oh my God, they're going to kill me for not knowing this off the top of my head.
They do these things in Dubai now, I hear. Like they
Yeah, the last one was in Dubai. It was phenomenal.
Oh,
Okay.
They have a bunch of events, but I would just check out the CMTassociation.org website. They've got all the events on there, and you don't have to be a member. You don't have to be. You don't have to. Yeah, you don't have to be a member. You don't have to be a CMT to go. But it's a great opportunity to go and see what's going on in that world, because I've been a member for a long time, and I've been a CMT and a CFA for a long time, and what I've seen change dramatically over the past 10 or 15 years is the level of the quality of people that come to these symposiums for the CMT Association, and the fundamentally minded investors that are coming around to appreciate how adopting some of these trend following and technical inputs into your process it's like Craig Johnson. I think you guys know Craig.
yep.
So
Yeah.
he's fond of saying that the CFA got him his job and the CMT has kept him his job. Right?
One of the best quotes. That's one of the most underrated quotes.
Yeah, but I think some of the best transformations I've ever seen of just outstanding fundamental portfolio managers, but fundamental investors transforming to incredible portfolio managers is when they start adopting technical analysis and trend following into the process. But it invariably happens after they get their face beat in, and that's when they say, okay, I need to obviously adopt some tools in my process that enable me to sidestep these 50% drawdowns.
We're going to let you go right now, but Sean, I think we should all agree right here, right now, because I think this was a pretty special interview that we did. You're going to have to come back, and I want to hear about some of those face beatings the next time we do this.
Yeah.
Ooh, a special episode about face beatings. I like this. I like where this is going.
Yeah, does that include the times I've skied into trees?
Yes.
Better. Yeah, I want to hear about how you blew up and shot a 100 on the golf course, all of it. Sailed into a rock, whatever.
Yeah.
Well, David, this has been truly special, as Steve said. Thank you so much for taking the time to do this. I know today was a very busy day in the markets, so thanks for taking the time, and looking forward to catching up with you in person again sometime soon.
Thank you, Sean. Thanks, Steve. Thanks so much for having me on. It's a real pleasure. And again, I commend you guys for having conversations like this. It's the most important conversation.
Thanks, David.
Thanks, David. All right, dude, that was great. That was great. Right? When you say, I mean, so much wisdom he had there. Unbelievable.
David, and I mean this when I talk about my trading, I think this guy has helped me as much as anybody without ever knowing it, right? He's the kind of guy where you have a conversation with, or for viewers or listeners of our show, you just listen to the way he talks and the way he thinks about markets, the way he thinks about his system, stomaching large drawdowns. That's just a part of business, stuff like that. These are the things that other traders need to hear. And Sean, I know that, we try to do this in an evergreen way. This will come out 2 weeks from now, but NVIDIA released their earnings today. And the whole world is going crazy with all of these extra excited takes. And we just had one of the most, well-balanced, even-keeled guys on here who could just talk about markets in, the most human, normal way, be calm, be cool about it. And I think that was extra awesome on a day where everyone's freaking out about all the wrong things.
Yeah, we started recording about roughly an hour after NVIDIA dropped their earnings, and everyone's going crazy. The social medias are going nuts. Everyone's on TV. Everyone's talking. And you're right. It was so refreshing to talk to him. He was just so cool, calm, collected. And that speaks to not only the type of guy he is, but to the type of trader he is, right? He's done it in a way that, he's got a system, he's got the rules, he knows there's volatility. He's figured out ways to work it to his benefit. He talked about that a little bit, both on the upside and the downside. I mean, the proof is in the pudding. That he's the type of trader and the mindset that we should all aspire to be. Right?
What'd you think about the myth busting or not averaging down on losers?
I liked it. You know what? I regret that I didn't have him expand on that a little bit, because the one question I did want to ask him was, okay, you will, if a position becomes a smaller, in basis points in your portfolio because it's going down, would you only add to it if yes, it's shrunk as a percentage of your portfolio, but you're still up in the position, or if you were down, would you not add to it? I wish I would have asked that question, because that's how I would have thought about it. Like for me, I'd be like, I would only add to it if I'm adding to a winner. If I'm adding to a loser, I wouldn't do it.
It's really good. The sailing parallels, what do you say? There's no destination, there is no target. Like on the long side, it said there's no target. We're operating in a world of trailing stops. We don't know where these things will go. People send us emails all the time. What's your target on this? You said something bullish about this thing today. What's your target and what's your time frame? I say longer and higher. I don't know, right? And the way he treats shorts differently. I would love to have him on again to talk less about trading, more about what he's doing all around trading, because he agrees with us, and he said a couple times just on the show, he thinks what we're doing is so great because we're talking about the things that no one ever talks about. David didn't just become this incredible trader, incredible portfolio manager, one of the real, true great technicians that's currently practicing. This didn't just happen out of nowhere. He's doing all of the right things in his life to get here, whether that's sailing or golfing or whatever, just keeping his mind right, eating healthy. What a healthy guy. I mean, just look at it. It looks great. He's got a great shirt on. Looks like he's ready to hit the course right now, play 9, tonight. Probably is.
You know what we got to do, Strazza? We need to get our video team from San Diego. We all need to jump on an airplane. We got to fly to Boston. We got to get on a sailboat with David and do the part 2 of this. And we'll keep going, as he said, until the wind changes.
I think also that the kind of next iteration of this podcast that we launch, we just go and golf with people or sail with people.
Love it.
With people. No, seriously, do all the things that we're talking about. We always ask people, what are you passionate about? What do you do outside of markets? And they tell us about their hobbies and what they like to do. We should travel, meet these people, and have these conversations while we do those things that help them keep their mind right and, make them trading successes that they are.
I love this idea. If there's any sponsors out there, potential sponsors out there watching this episode, you can help make this happen. Sponsor the show so we can afford to do this and bring you awesome, amazing content. Great idea, Strazza. You just earned yourself applause.
That was a great conversation, Sean. You and I have been on camera for like 4 hours today. So
let's go take a nap.
Straight from my office to my bedroom and hit it. But no, that was truly special. I'm so glad we finally got him on. Again, this is somebody that we wanted on right off the bat at the top of our list. So
yeah,
special interview. Glad we did it.
Awesome. Great job, buddy.